I would argue at least 50% of the market is almost completely priced out.
Wow, 50% of the market is priced out of the car industry.
Yeah, if you think about the retail vehicle market, the most important number is the monthly payment.
100%.
When you look at what households in the US, the distribution of their incomes, about half can only afford about a $400 payment.
What's up, everyone? This is Car Dealership Guy. You're listening to the Car Dealership Guy podcast, which is my effort to give you access to the most unbiased and transparent insights into the car market. Let's get into today's episode. Jonathan Smoke is the chief economist of Cox Automotive, a subsidiary of the $20 billion Cox Enterprises. In this episode, we discuss the state of auto lending and what's to come, how interest rates are impacting the car industry, the number one issue for car shoppers right now, the best and worst car deals on the market, what a UAW strike could mean for the auto industry, winners and losers in the EV space, and will used car prices go back to normal anytime soon? But before we dive into the show, theft is plaguing dealerships nationwide. Losing car keys is an unneeded cost, and searching for keys can lead to bottlenecks in the sales process. KEYper Systems has the solution for dealers. The KEYper MX is the number one key control solution in the auto industry, handling millions of transactions per day. It features a 16-gauge steel cabinet with a built-in camera and a puck lock for additional safety, along with many other features so that dealers can know who took a key, when, and why. KEYper Systems has been in the auto industry for over 40 years and is in over 12,000 dealerships, offering exclusive key control for 6 out of 10 biggest automotive groups in the world. They have a wide range of products that fit the needs of franchise dealers, independent dealers, and even the smallest pre-owned lots. New customers can take advantage of my partnership with KEYper Systems right now to receive an exclusive discount. All you need to do is visit KEYperSystems.com, click on the Car Dealership Guy link, and fill out the form to receive 25% off your first key machine purchase. Or if you prefer to call, just mention Car Dealership Guy to receive your discount. KEYperSystems.com, KEYper Systems.com. All right, folks, we got Jonathan Smoke on the pod from Cox Automotive, or as they call him in the streets, DJ Smokey Smoke.
It's good to see you again, CDG.
You too. Thanks for coming on. The most creative economist I've ever met, so pumped for this one. People are probably wondering, what's DJ Smokey Smoke? Well, you should have listened to the first episode where we gave some context on your DJing career. So
it's a low bar for the world of economists, to be entertaining and creative, but I try to keep up.
Well, look, we have a lot to cover. Haven't done a deep economy, just industry segment since our podcast, really. And so I think kind of to lay the land for a second, and I'll let you introduce yourself to all of our new listeners. But it feels like it's been a lifetime since our last episode of what's changed in the industry. In reality, it hasn't been that long. It's been a couple of months. But since then, just to give a preview, we've seen new car sales continue to rise year over year. We've seen used car prices kind of decline and then increase just a little bit. Now we're seeing these potential strikes in Detroit with the United Auto Workers, specifically strikes that could potentially impact production for Stellantis, Ford, GM. We're seeing Elon Musk and Tesla cut prices on their EVs, new cars, like 20%. I mean, just crazy price cuts overnight. And again, this was super recent, a couple of days ago or so, a week ago. So we still have yet to feel the impact there, but there's so much going on. It's going to be a very juicy episode. Before we get into that, can you give our new listeners, can you give us your background and exactly what you do?
Sure. So I'm the chief economist for Cox Automotive. For folks not familiar with Cox Automotive, we are the largest services company for the auto space. We basically have some familiar brand names to consumers like Auto Trader and Kelley Blue Book, where consumers go to shop and learn about vehicle values and the like. We have the top 1, 2, or 3 software platforms that dealers use to manage all aspects of their business, from CRM to inventory management to the back-end DMSs. So our bread and butter software businesses are very much focused on supporting dealers. And as a result, I work with dealers day in and day out. And then most people know me because of the Manheim Index. So we own Manheim Auto Auctions, the world's largest wholesale marketplaces. Folks that listen to the podcast, you mentioned going to Manheim, PA on a regular basis, and what a trip that is in terms of where it's located and what that's like. So, I've been in a role as a chief economist in the housing industry and now in the automotive industry. And I came to Cox 6.5 years ago, leaving behind my background in housing to get into automotive as a new learning opportunity for me, but really to leverage the vast amount of information that we have at our disposal to really get to understand and know this business. So, bottom line, what I do day in and day out is to try to make sense of what's happening in the world, and specifically relating that to trends we're seeing in the auto market, because I'm trying to help people make good decisions. And that includes manufacturers, dealers, and lenders and consumers alike. So I'm a big fan of the podcast, and I too am learning. So I want to continue to contribute to this world.
I love it. Did you see my long form post? Is that what you're referring to about the Mannheim trip?
Yes,
Yeah.
yes.
Yeah, good. I'm glad because it's funny. I was thinking to tee up the Holland's Head podcast, largest wholesaler in the world. And I was thinking about, like what's better than to just illustrate kind of what that experience was like starting out.
Yeah.
Yeah, it was kind of like off the whim. I didn't really plan or anything, but it was funny. I ended up striking a chord with lots of people. So that was awesome. All right. So give us like the 4,000 foot overview of like what is going on right now in the car industry in general.
Yeah. Well, there's always something going on. and we last talked just about 3 months ago, and I totally agree with you that several things are changing or have changed in that time. Fundamentally, if I take a step back, I would say that we're increasingly seeing the auto market move towards normalization and balance. We've basically been in a world where the decline in new vehicle production from every factory in the world being shut down back in 2020, and then all of the crazy supply chain issues that happened as the manufacturers tried to get back up online, meant that we have been severely undersupplied in first the new vehicle market, but now that's cascading into the used vehicle market, because the absence of new vehicle sales for 3 years in a row constrains substantially what can happen in wholesale and in the used retail market. So we've had a lot of abnormal trends. We've had demand exceeding supply, so that caused tremendous price inflation, first on the used vehicle side, and then that cascaded into new. And this year is starting to see pricing come down again. Of course, you're dealing with the economy and the issues facing the economy with inflation, and then the medicine being doled out by the Federal Reserve that includes monetary tightening and, most importantly, substantial increases in interest rates. So you combine price increases with the higher interest rates and tighter credit. We have a real affordability challenge in both the new and the used market that limits demand, and it's helped produce some of the normalization we're seeing, because there are, I would argue, at least 50% of the market is almost completely priced out of being able to buy the way that they traditionally would.
Wait, so what do you mean by that? 50% of the market is priced out of the car industry. What's specific?
I mean, at the end of the day, if you think about retail, the retail vehicle market, it is a financing market. People, the most important number is the monthly payment.
100%.
And when you look at what the households in the U.S., the distribution of their incomes, about half can only afford about a $400 payment. And it is really difficult to produce a $400 payment in either the new or the used market today, because of the combination of vehicle prices and interest rates. And so it ends up being a market that's largely, you get a tale of two different stories left and right. I would argue consumers are living in two very different worlds, where high income consumers that own homes and lock down very low interest rate mortgages are enjoying almost the best of times, because they've got low debts that they're paying, and at the end of the month they're seeing their stocks go up in most months, and home values go up, and it's a really positive story. The other end of the income spectrum, you basically see consumers who spend more than half of their budgets on three things: food, energy, and shelter. And those things, that's where we've had the most inflation. And so they've been experiencing tremendous inflation and just trying to make ends meet. But those consumers tend to be consumers that traditionally drive the used car market and are a substantial portion of what we call subprime in the credit space. And so they're seeing interest rates that are north of 22% these days. And it's really hard to get a $400 payment on any
vehicle that you can actually get financed. So with all that said right now, let's just start with used for a second, right?
Yeah.
I always saw this chart. I forget who put it out. It pretty much showed this like hypothetical like underproduction of vehicles since 2020, right? It was like, we've underproduced 8.5 million vehicles since 2020. And all it's doing is going by what we should have sold in normal times versus what we actually sold. And it's also not perfect because people are holding their cars longer and whatnot. But when you look at something like that, and given the fact that, inventory, used cars are still at historical lows, or at least for a certain period of time, which I'm sure you could provide more data than I can. How are used car prices rising again as of like the past month? Like what's going on right now, with interest rates and everything and people being priced out? How are prices going up again, at least on the used side?
Well, we're fundamentally very constrained. So to the point of the people who focused on the underproduction that we've had, think about it this way. Prior to the pandemic, we basically had a car park that was growing by about 5 million units per year. We were adding 4 to 5 million units. And that's the difference between the new vehicle production and sales that happen in the new market minus the vehicles we lose, what we refer to as scrappage in the industry. So the net effect was
Yes.
we were growing the car park by 4 or 5 million.
So and give me like rough numbers. How many cars are operated in the US nowadays? Like
About 280 million.
Okay, 280 million. And if we were selling what, like 18 million new per year, 17 million?
Yeah, we were selling north of 17 million for almost a full decade leading up to the pandemic.
Okay, which means that, and then you're saying we're scrapping like 12 million or so, we're kind of going out of operation.
Yes. And so we've had several years through the pandemic, actually the first 2 years of the pandemic, the car park shrank because we actually lost more vehicles than we were bringing into the market as new. We've basically, in 3.5 years, we've added about 1 million vehicles when normally we would have added, by this point, about 15 million.
So everything is just like out of equilibrium at that point.
And then throw on top of that, we've actually had a shift in where people live and their preferences for transportation. Plus, we had 2 years of what we can characterize as the free money years, both in terms of stimulus and interest rates being rock bottom. So you actually had stronger demand than normal for the last 4 years.
Tell me more about, you said preferences in transportation. Like what changed? What do people want now that they didn't, 3, 4, 5 years ago?
Well, first, obviously, when COVID was a major concern, there was an enormous shift of people no longer wanting to share transportation. So public transportation fell dramatically. Even ride hailing fell dramatically. You really had a preference for, I want to be in my own vehicle. I want to be in my own bubble. But then on top of that, when people started primarily working from home and driving more of what is still today very much a hybrid work situation, people were starting to migrate and look to own houses in places that were more affordable or more enjoyable. So you've seen a mass migration from high population dense areas like New York City, Chicago, San Francisco, to secondary markets and more rural locations that are absolutely more
Exhibit A.
private transportation specific.
Deurbanization, yeah.
Yeah. And so the vehicle has become even more important to households. And I would argue their use cases, which used to be a lot simpler, most mileage being put on cars pre-pandemic was driven by your daily, weekly commute. Today, the commute is more complicated and for some folks isn't even an issue. And instead, you've got a model where I don't have a daily driver anymore. I have a vehicle that I need to drive to work a couple of times a week, but then I also need to haul my family around, or I need to be able to tow a boat on the weekend, every couple of weeks, or whatever the situation. I would argue the use cases for consumers have gotten more complicated too from a vehicle standpoint. So we had a tremendous amount of people back in 2020 and 21 when they were getting stimulus money, when interest rates were zero or near zero and the lowest that we've ever seen, basically changing vehicles, both new and used. Best retail sales ever were in 2021, and mostly driven by the volumes we had in the used vehicle market. But then last year, that started to come to a screeching halt because one, pricing started to go up dramatically in both 2020 and 2021. But then you had the Fed raising interest rates, and that really started to change the story.
So how have interest rates most impacted the industry, would you say? Like someone asked me today, someone was like, hey, so interest rates rising, like, so what, are people's monthly payments changing? I said, well, no. I said, it doesn't affect it that way, but it's affecting in other ways, right? Suddenly you have to pay more for that house. And so I'm curious from your take, what is the impact of these interest rates, right? And will it be like short-lived, long-lived? Like, can you walk us through that a little bit?
Sure. And that's a great point. It does not, the auto market, much like the US housing market, which by the way is relatively unique in the world, people are not subject to variable rates on the vast majority of loans that they have. So rising interest rates basically only impact new buyers. They don't impact existing buyers. However, in the vehicle market, most people who are buying a vehicle or selling a vehicle, so you have a potential lock-in effect that what we may see is a much more muted amount of demand out there because people net will look at their situation and say, I can't really improve my vehicle circumstance because my payment's going to go up so much. You can't really figure out the calculus that will drive it. So it's more a limiter on what we can sell now versus what we could sell before. And where we see that most evident is again with consumers who are facing the biggest affordability challenges, which are principally lower credit quality consumers. And we've effectively seen subprime almost disappear from the new vehicle market. And in the used market, we've lost about 5% of the market that used to exist. So you literally
Does
have
that matter? Is that 5% that's like at the fringes, or is that like a 5% that has no other options? Like, how important is that 5%?
Well, I would say it's important. It's materially important, and it's especially a good reason why when you look at our surveys of dealers and our dealer sentiment, which we're rolling out the third quarter this month, it's why persistently franchise dealers have been more positive about the whole economy and the auto market and specifically the used vehicle market than we see from independents. Independents and those who service more of the credit challenged consumer have seen the biggest struggles. And some of it's inventory related too. I'm not dismissing that there's also an issue with what vehicles are available and at what price, but credit plays an enormous role in that.
Give us an update on the inventory situation, new car side for a second, right? People ask me, they're like, hey, like, why can't I still get a Toyota? Why can't I get a Honda? But I can get a Chrysler Pacifica. So give us why are some manufacturers still dealing with supply issues 3.5 years later? I mean, come on, like, something doesn't make sense. Walk us through that.
Well, it hasn't been an even tide. And so largely what we were seeing last year in particular was that European brands and Asian brands were far more likely to still have lingering supply chain issues. And in particular, the brands that we saw that were furthest behind were indeed the Japanese brands, with Toyota being the most high-profile one that seemed to be behind everyone else in seeing the recovery. And it was a litany of bad luck. Basically, there was an earthquake early in 2022 that set Toyota back specifically. It also impacted one of their major sources of semiconductors. So while others were solving their computer chip problems, Toyota was actually having newer ones last year. The lingering issues in Europe were mostly related to disruptions from the war in Ukraine, which you don't hear about vehicles being assembled in Ukraine. We don't have a single vehicle sold in the US that is impacted directly by Russia and Ukraine. But Ukraine played a pretty important role, kind of like Mexico does for some of our vehicle production, where significant portions of the vehicle, like wire harnessing, was done there. And obviously that was disrupted, but it was also the disruption of fuel and other kind of costs in Europe that caused some of those supply chain issues. But flash forward to now, even Toyota is very close. In fact, I think they set a world record for themselves in July for the amount of vehicles that they produced across all their factories globally. So I think we are finally at the end of the more significant supply chain issues, just in time for a strike, or actually multiple strikes, to start unfolding in
Well,
this
what
month.
I want to jump into that, but before we get into that, one more quick question on Toyota. So do you think from here, do you think we're going to see, again, all else being equal, right? There can always be some black swan event, but do you think all else being equal, are we going to start seeing prices start to improve on Toyota, the Asian brands?
Yeah, I think we're moving towards normalization, and normalization will mean more inventory. That higher inventory is going to be more incentives. That is going to mean a return to discounting rather than paying above MSRP. We've already seen that for the brands that are more well supplied, but we're still, I think the average gap between what a consumer is paying to the sticker price or the MSRP is less than 1% so far this year, when we were consistently experiencing 6 to 8% discounts pre-pandemic.
Oh, got it.
So we will be seeing steps towards that direction. Do we get all the way back to what it was before? That's a matter of debate, because some would argue that because we can sell more vehicles on order, and the approach that many manufacturers are going to try to take to do more regional distribution, that we may net never get back to quite the same number of vehicles sitting on dealer lots. If I had, as an economist, I don't feel strongly around the arguments of why can that happen simply because manufacturers will, quote unquote, be disciplined. This is an industry that has high fixed costs with different global and kind of company specific strategies. It only takes one player to push the entire industry in the wrong direction. And Exhibit A is not so much one player, but if you look how quickly inventories have grown this year and how fast incentives have followed. I mean, incentives in August, we just got the numbers this morning. Incentives were up over 100% year over year. So it isn't, even though inventory levels are still relatively constrained, as you were pointing out, we're already seeing, that manufacturers are really working hard to make the most out of the situation. And
But those inventory levels where are they? Isn't it mostly domestic brands like GM, Ford, Stellantis?
yeah, so when you look at it, it's more the domestic brands that are more likely to be normally supplied or close to being, in some cases, oversupplied. But there's also segment level differences. Like, I would say one of the things that's become absolutely clear since our podcast is that we've hit the first speed bump in electric vehicle adoption on the new vehicle side. So that's the one
What do you
piece
mean by that?
that supply is building up rapidly of electric vehicles relative to the rest of the market. If you
So tell us more there. Like what are you actually seeing, like day supply? And also I'm curious if you're seeing that for everyone excluding Tesla.
Yes. And in fact, most of the data we put out, and we put out regular information in terms of, I do a biweekly video, and then we do some detailed inventory reports using our vAuto platform. And vAuto is the top industry source of inventory management for dealers. So a lot of folks worldwide swear by Dale Pollock and his philosophies with velocity and inventory pricing and management. And so we basically have the tools that let us track it. We do not have Tesla in our numbers. So what we're seeing in
Why?
the data, because Tesla is not a dealer customer, first and foremost. So we don't have Tesla actively participating in that platform to give us visibility into 100% of their inventory and how they are pricing that inventory. And the second is they're much more difficult relative compared to traditional dealers in terms of their approach to advertising specifically what they have available to sell. Essentially, what I would describe as what's behind our numbers is if a VIN is being actively advertised as available, then it's in our inventory numbers. So there's sort of no question. You can drill down to the make, model, and specific vehicle to know where it is and at what price and ultimately who's selling it. So our numbers track the industry numbers extremely closely, and I look at it actually every single day, but we share results sort of weekly, and so back to the theme that we were describing. If you look in aggregate for the new vehicle market this year, days supply has gone sideways to slightly down, and days supply is simply the total inventory level divided by the active current sales pace. And we use a simple rolling 30-day sales pace. The industry does, when manufacturers report their numbers, they do a more, I'll say, sophisticated calculation where they take into account the number of selling days in the month. And it basically reduces the days supply a little bit more aggressively than what our numbers do. But nonetheless, what we were seeing in the trend was day supply has been coming down all year long, or at worst gone sideways, which means that despite inventories growing, and inventories have been up consistently about 80% year over year so far this year.
Is that EV inventory or total new car inventories?
Total new car inventories, what are sitting on dealer lots, what are actively being marketed.
Up 80% year over year. And what are the actual numbers?
Currently, we were right around 2 million total new vehicle units sitting on dealer lots.
Okay, 2 million, that's up 80% year over year. Okay, so going back to your point on EV specifically, we were seeing in the market this year where day supply was coming down while inventories are rising, which that would signal strong demand, right?
That is correct. That's a good signal that if day supply is holding steady while you're increasing inventories, it means the market's absorbing what you're delivering, and you're not having a pileup of supply that would make you worry about future potential or future vehicle values. Well, the one exception to that is battery electric vehicles. Their inventory has increased almost 400% year over year, even faster than the sales pace, which year to date is up about 80%. Which means that the days supply number has been accelerating in its increase. And we're currently at a days supply for EVs above 100 days.
So what happens
and
next?
That's more than twice that we see for the new vehicle market.
That's very high. I mean, that's, twice like the average. So
what happens next is, what are all the things you normally see when something is oversupplied? Discounting, which you already mentioned. I mean, Tesla's the 800-pound gorilla in that space, and boy, are they exerting their muscle. And by the way, from my view, it's working. If there's any clear victor so far this year, it's Tesla, because they're maintaining their share. Yes, they're making less money per unit that they're selling, but they are not struggling the way that we are seeing some traditional brands. And I think some of that boils down to some of the adoption issues that we're running into. Because if you think about where we are, we basically have been selling battery electric vehicles to the choir. To use the religious analogy, we've been selling to the people who absolutely have sought them out and wanted to be the early adopters for multiple reasons. Well, now we're trending towards a policy that suggests at some point in the future, the average American has to want and buy a battery electric vehicle. And there is a big difference between the choir and the average American. And some brands, like Tesla, how Tesla's brand or other new entrants like Rivian line up with consumers, they're in great position because consumers align with those brands and think of battery electric. Some other brands, like traditional brands, including high-profile brands with battery electric vehicles like Chevrolet and Ford, don't have quite the same lineup with those consumers. Their consumers are actually not eager to get battery electric vehicles. And you also look at where those brands traditionally have sold, they're in the heartland. They are everywhere. They are not concentrated in California or in the extreme urban.
The coastal cities. Yeah.
Yeah, so we're just at an interest. I'm not, and by the way, I'm not conveying that I think battery electrics don't have a future and won't continue to grow. I think this is the first of many speed bumps that we're hitting as an industry. I actually think the number one issue to consumers is pricing. And we're already seeing what happens when you're oversupplied. Prices come down, and that's going to cause more consumers to consider EVs. And some of the other issues like charging networks, those are chicken and egg issues. We solve those issues when we have more battery electrics that are in the market. And for example, companies that can see a profitable path to making all the investments they need to do with chargers. So some of those other things I think are better.
Everything you're saying makes sense, right? Like if we're going to see more discounts with EVs specifically, who do you think are going to be the winners and losers here? Right? Like is Tesla the winner and everyone else the loser, or what does it look like?
Well, in the short term, I definitely think from a branding perspective that Tesla's winning this inning or this quarter or whatever sports analogy you want to put at it. And it's really hard, if you look at the longer term forecast, we've got pipeline supply directed forecast out to 2040. And at no point does Tesla not have the top market share in that forecast
for EVs.
So yeah, of course their market share erodes over time. And by the year 2040, some other brands like Toyota will be much closer to them in terms of their share of the market. But Tesla is a strong incumbent that I would not bet against. And I think this year again is living proof that they are doing well.
What do you say? And by the way, what do you think about Toyota's like wait and see approach on EVs?
I personally think it seems to be working well. When I talk to their dealers, to a person, they like that strategy. They think it lines up with what their customers are seeing. The market in general is seeing the most strength for hybrids, and that path and having an established expertise in making hybrids work, I think historically has been good for Toyota and will continue to be a strength. But they're also highly rumored to be near announcing something with solid state batteries that could really change the whole battery electric landscape. And oh, by the way, what's the one brand with real experience with hydrogen, which is the other fuel that would help to address some of the range and other use cases like for medium and heavies. Toyota is definitely one that I think, for a variety of reasons, has to be viewed as a long-term strong performer here. The rest, I would say it's sort of a mixed picture. You're going to have some growing pains because some brands are going to have to work harder to sell the same number of vehicles because their traditional customer is not an easy sell in terms of where they live and their orientation towards accepting battery electrics. I think some brands are going to struggle. Every brand is in this game. Every brand has multiple models in the pipeline. Some are more aggressive than others.
You're saying it's like EV models specifically, right?
Yes.
Got it. I want to flip back for a second to the used side. We know that here, like you just mentioned, on the new side, we're seeing the state supply increasing very much with EVs, with certain brands. The average used car is up like, I think 45% or so since 2019. Pricing, roughly, correct me if I'm wrong there, it's like 45%. Or are we going to see this like slow but steady decline in used car prices? Or is this short supply going to just buoy prices and used cars are not coming down? Like you might as well forget about it if you're in the market for a used car. Where are we at?
Yeah. I mean, my view is that we are very close to what a balanced market price level suggests where we should be. And in other words, what I'm expecting to happen from this point forward is more traditional depreciation happening and no more price correction happening in the used vehicle market. And the reason why we're more likely to trend in that direction is because we still have a scarcity of vehicles available. And it's especially true now, more so in the used vehicle market than the new vehicle market. And that scarcity doesn't get solved for at least 3 more years, because we basically can't sell the same number of used retail vehicles in 2023, 24, 25, because we just don't have the flows coming through the wholesale market, either through physical auctions or other platforms, because of the lack of leased vehicles, the lack of rental vehicles, lower levels of repossessions, other things that basically fundamentally drive what's available for dealers to sell retail. So it's going to be, the supply is going to be limited. But yet on the demand side, this summer is living proof of the situation that as we simply see used vehicle values come down, we create demand, because we've had thousands of people priced out of the market. And we hit the peak in used interest rates in late March while the banking crisis was going on. And it's one of the positive factors that has certainly not only not gotten worse, but has actually gotten better for the consumer since then. Yes, we did see interest rates drift up in August, but to start September, used rates are trending down again. We're more than a quarter of a point off of the peak for the year. But most importantly, wholesale prices came down strongly in April, May, June, and July. And then that started to trickle into the retail market, especially more so in June and July and into August. So suddenly consumers who were looking for a price point, looking for a specific monthly payment, started to see it. And what happened? Sales started to pick up. And we were seeing it loud and clear in our Viato data starting in early July, and it's only progressively gotten better as we got through August. And I would argue it's proof that when you're in a tightly constrained market and you have no other big negatives happening, like a recession unfolding, if the consumer is employed and it's just a matter of affordability, then normal depreciation is going to create buying opportunities. It's just a matter of time.
What is normal depreciation? Like, what do you expect to see in a normal year on a used car?
On a specific vehicle, it gets complicated when you look at averages like the Manheim
Yeah.
Index, but on a specific vehicle, you should see around 10 to 12% depreciation in an average year on an average car.
Yeah.
Brand new cars tend to lose more. Older, middle-aged cars tend to have a period where they lose the least amount, but over time, it magically starts to average 12%, 10 to 12% down a year. And we've definitely not had normal depreciation for several years. We also weren't driving as much too. And if you think about depreciation, what fundamentally two factors
Mileage.
cause
Yeah.
depreciation? Mileage and time. Because time, things get old. It's not quite as shiny and new, all of those factors.
So let's talk about the other element here that might have a adverse impact on depreciation, the strikes. What is going on with these strikes? First of all, do you think it's going to happen? Which I personally, based on all the information I've been reading and consuming, I think it will, but I want to hear what you have to say. And then second of all, if it does happen, what do you think will be the impact on the entire car industry?
Yeah, I definitely think it will happen. I see the parties
Okay.
as being
So we're aligned there.
so too far apart, and with too much, both sides believing they have too much to lose to sort of compromise early in this process. So then it becomes a function of, well, then how broad is the strike and how long does it last?
And quickly, I want to chime in for anyone in the audience that's not aware of this. I doubt anyone is, but just in case, United Auto Workers, right? Workers that produce cars here in Detroit. So they have been, pretty much saying that they're going to be striking. They want increased pay and other things, a shorter work week or whatnot. You could Google it and get all this information. But the long story short here is this could, hinder or completely stop all new car production, right? Which obviously would be a bad situation because, again, we would get into shortage situations. All right, back to you.
That's right. It would reverse a bit of the progress we've made, or or potentially maybe at best just simply postpone further improvement. But that's where how broad the strike is, because effectively the UAW only really impacts the traditional domestic brands. So the question is, do they strike one or all three, or a combination? And I'm not an expert on the labor market, but from people that I truly respect and I think have their finger on the pulse, the odds-on favorite to have a strike is Stellantis, followed then by GM, and Ford is probably below 50% probability of having.
Ford just put out this video. Did you see it by any chance? Did you see their
No.
little commercial? No, they just put out this commercial, like, I don't know, it felt like propaganda or something, but it's on their Twitter page. I was like, interesting. It was a bit rosy. Like, let's just put it like this. Based on what you're telling me right now, that aligns with what they put out, because it was a very rosy picture, which it's, based on what I've been seeing and hearing, I was sort of surprised that they would put out something that rosy in this type of, 10 days before their production is potentially not going to be working anymore. So anyways.
Well, they're hoping that they keep those odds low. It's not unlike a political ad in election season. I would argue what it sounds like. So then, if you think about it, none of the other brands that sell in the U.S. are impacted by this. So historically, when strikes happen, it really doesn't have a material impact on the aggregate sales numbers. The last
people
big strike
just flock to
happened,
other brands or something.
Yeah, other brands do better in those time frames and take position. So the last big strike for the UAW was against GM. It lasted over 40 days. In 2019, I challenge you to look at the sales numbers and find when that happened, because you won't see it in the numbers. Mm-hmm. But that was also a market that was already oversupplied and had plenty of inventory on the ground for both GM brands and other brands. So, this time could be different because we are coming out of the most constrained market we've ever been in. So I'm not saying that we won't necessarily see some impact. Where it would probably impact us the most is, one, no longer seeing inventory grow and starting to see days supply contract a bit. Along with that, we would expect to see incentives no longer growing. Now, that hasn't happened through August. As I mentioned, we're up over 100% in incentives year over year in the month of August. So I think it's going to be first apparent in the incentives that are being offered, how many low APR deals are being offered. I would expect all the manufacturers that aren't deliberately trying to gain share in this period to potentially become a little bit more conservative. But mostly it's the dealers. It's the dealers with the stores for the brands that are being disrupted that face the biggest challenges.
Do you think the UAW, United Auto Workers, do you think they're maybe like overplaying their hand? I mean, if you said Stellantis, they have the most inventory in the market right now. Like, are they sitting in their boardroom, like kind of chuckling, like, cool, like let's take a 30-day break here, get supply levels back down? It just buys them time. They're not under pressure. Like, how do you view that?
Well, I think the UAW has some strong arguments behind what they're looking for in terms of restitution of some pay and benefits that were cut back in the Great Recession, and essentially looking at lack of progress that they've experienced for quite some time. You can argue that they definitely have a reason to be holding out for more. Now, deliberately choosing Stellantis, I don't know the details of the contract specifically with Stellantis and why Stellantis first. But part of the reason why Stellantis is so well supplied right now, I think, has been preparing for this, deliberately being focused on having something to sell, and knowing that they would most likely have a disruption come this fall. Stellantis was being conservative. I mean, they've been what I would characterize relative to the market as oversupplied all year long. and they have not been super aggressive with incentives or financing deals or leasing or selling into fleet. They've done some of those things periodically, but they've definitely been building up a war chest of inventory to be able to leverage in this situation. So it's two groups, each with war chests, each with, in some cases, some would argue, existential reasons to be fighting. And by the way, one of those key reasons that both is worried about is electric vehicles.
What
Because
specifically?
the UAW is concerned that unless they get concessions and agreements from the manufacturers, that future electrified plants will be unionized, that some of those plants will not be unionized because building an electric vehicle is less work. It's less complex. It doesn't take as many workers. You're working right up against companies like Tesla that are not unionized, and from that perspective, potentially have a cost advantage. So you can see why both sides are very worried about it. Because if the future eventually becomes 80%, 100% electrified, then what is the UAW's role if none of those factories
So
are union?
yeah, I mean, so let's say for a second, right? So strike happens. We don't know how long it'll be, but let's just say it starts with Stellantis. You said people go flock to other brands. What are we going to see in Q4? Are we going to see inventories decline, prices start rising again, or at least fewer discounts and rebates?
I would expect that to be the case in aggregate. I certainly would expect to see no further progress on the SAR. I would expect the SAR to have some of its lowest sales paces of the year for new vehicle sales.
And just for people that don't know, like SAR being the amount of new vehicles that are sold in a year, pretty much.
Yeah, it's the seasonally adjusted annualized rate for every month that essentially tells you if you
Yes.
kept that up for an entire year, this is what your pace would be.
And we are pacing right now. What's the number?
Year to date, 15.4. August was one of the slowest months since the very beginning of the year at 15.
And what was 2019? Like 18 million or so?
17, right on the dot.
17? Got it.
And
Okay.
last
So,
year
I
was
mean, we're not
13.8.
13.8,
Yeah.
2022. What was 2021?
It was a little bit higher. I think it was 14.1.
Got it. So 13.8 was like the bottom, at least for now.
Yeah.
Hopefully. Wow. A lot of moving pieces. All right. So before we jump into the state of the lending market, a lot of requests for like lending and interest rates and stuff like that is very interesting. A lot of people are, really curious about that. But before we jump into that, like give us some favorite buys. Like where are you seeing deals right now? I mean, you have your figures on the pulse here. But like where are you seeing deals for consumers? Like what cars right now would you recommend to a friend if they're like, hey, I'm looking to get a good deal right now on a car? What is it?
Well, electric. The best
Anything
prices
electric.
for almost any brand, that has been offered, and you're far more likely to see incentives. What's interesting, the tax credit, the IRA created a really the way the IRS interpreted the rules in the IRA created a very big loophole that more vehicles are available to get the tax credit if they're leased than not. But it's at the discretion of the finance company doing the lease on whether or not they actually apply it. And so far, we're not seeing consistent evidence that all brands are aggressively pursuing that. So I would be looking at leasing offers, because we are seeing lease offers improve, and they tend that tends to be a place that manufacturers will go first before they go to more cash on the hood or deliberately cutting prices, in the marketplace. I think we're seeing more buying opportunities and more discounting all summer long in the luxury market. So I think you're in much better shape if you're a traditional luxury buyer to be looking at luxury. And again, I I would be looking at leasing first as potentially a place where the manufacturers are getting more aggressive. You know, I can also highlight where I wouldn't start looking if you're purely looking for a
Go ahead.
deal.
Yeah.
I mean, Toyota is the least supplied, and year to date has been the least amount of discounting that's out there. But historically, Toyota's always been that way. So if instead you look at it by you're no longer paying a premium, I'm actually hearing some individual Toyota dealers tell me that for the first time in August, they're selling vehicles closer to invoice than sticker.
Toyota dealers.
Yeah.
Wow.
So
what cars are those? Are we talking Corollas or?
I think it was a broad mix across the board. And again, if you think about the situation, Toyota finally has supply. And if that's happening with Toyota, then what do you cascade down to the competing brands? My guess is if you're in the market for a vehicle, then right now, before the strike potentially starts to change behaviors, the first couple of weeks of September, it's a lot of people tell the folks not to buy until the last week of the month, but that's actually not true across the board in terms of getting the best deal on a vehicle. Actually, you can quite often get some of the best financing deals early in the month.
Why is that?
I'm not certain why that's the case, but what I tend to see in the data is that people who buy in the first week of the month tend to be the people that are most actually price sensitive, looking for specific new programs that are coming out, and they seem to pull the trigger. So you disproportionately get people who are hunting for like specific programs and financing deals as opposed to just negotiating.
Interesting. Yeah. Maybe it could be, with like people getting paid or something, and they're the more kind of budget conscious people, so they just got paid and they're going to use the money towards the vehicle.
Yeah.
We've definitely seen that on like, people get paid Fridays and stuff. You see an uptick of just, consumer traffic on Fridays, right? People get paid, come to, buy a car. So, all right, let's talk about lending. So what is the deal with lending right now? And just kind of walk us through, if you can, repossessions, delinquencies, right? I did look at some Cox Automotive data. Looks like we are, from a delinquency or repossession perspective, back to 2019 levels, I want to say, but I'll let you kind of give us the lay of the land there.
Yeah. So credit has been...
Is the market melting, or are people overreacting?
The market is not melting. I will definitely sort of call that out specifically. If anything, the market is simply normalizing in some key metrics like defaults and repossessions, and we're not even back to 2019 levels with those activities.
What is that number? Can you share that exact number with us?
Sure. So the default rate, for example, and that's what matters the most, because a loan has to be in default before a repossession can happen. And we look at Equifax data every month to judge how auto loans are performing. And year to date, we've got a default rate in 2023 that is 2.5%, and it was 2.9% last in 2019. Last year, it was 2.2%, up from an all-time low in 2021 of 2%.
So 2.5% of all auto loans in the market are in default, and that's below 2019 levels of 2.9%. Okay, got it. So, and that's below 2019, which is decent. But what about S&P Global put out this data, which was like percent of ABS loans 60 plus days delinquent. And they showed that we are at the highest rate since 2009. We're actually higher than 2009. It's at about 5.5% roughly. Talk to us about that. What is that?
So that's been where we've seen more evidence of stress, has been in delinquencies. 30 and 60-day delinquencies on auto loans have been at record levels every month this year for the specific month. There's strong seasonality in delinquencies. People are usually the furthest behind in January, coming after the holidays and pre-tax refunds. And then when tax refunds hit, delinquencies fall because people are using the tax refunds to catch up. and then we start to see delinquencies rise again. So we have been seeing delinquencies pick back up. Their pace of growth, though, slowed in the month of July, and I'm anticipating in the month of August for there to be less growth in severe delinquencies. But from a total amount of people that are behind 30 to 60 days, it is definitely at historic levels. We've got data back to 2006, and it's the worst July compared to any July back to 2006. But what we're not seeing happen is people are falling behind 30 or 60 days, but they're curing their situation.
And that was going to be my next question to you, right? Like, what are these loan extensions? Like, that's like cheating. Like, how can you just extend a loan? Like, what is this? Explain this to me, because I did not come from this world, right? So I view this like so simplistically, right? A loan is delinquent. How can you, or it's about to go into default. How can you just extend that? Or is that just the bank saying, hey, we don't want to take that, we don't want to realize that loss yet? Or what's the deal? Go ahead.
Well, two things. And it's actually key to understanding why this is actually a symptom of inflation versus a symptom of absolute distress that leads to further problems and credit really evaporating in the auto market. Usually delinquencies are high when people are losing their jobs. People are not losing their jobs. People, yes, the unemployment rate ticked up in the month of August, but it was because more people came into the labor force. We've actually added over 4 million more people to the payroll rolls since the pandemic. And we've had historic, beyond 50-year lows of the unemployment rate. And most importantly, for every unemployed person, there's 1.5 jobs available to them, which is leading to above average wage growth. So usually lenders are worried when people are losing their jobs, and you don't cure somebody who's 60 days behind and extend their loan or come up with a new payment plan for them in the circumstance when they're not gainfully employed. So that's a key difference. The other difference is vehicle values. As we were sharing, vehicle values have not and will not go back to the levels that they were in 2019, where we actually see loan vintages. Loan in the loan performance world, people talk about vintages, so it's based on what month was the loan created. Well, loan vintages for new vehicle loans, there's not a single vintage yet that has below average positive equity, meaning every new loan that's been made has basically more equity in it than it normally does at this stage in its life. And
since when, though? What time period are you talking about?
All time periods. I'm talking all active vintages of new loans, and boiling them down to each month.
So inflation pushed up values. People obviously have more equity in their vehicles.
Inflation pushed up values, and people have put the most they've ever put as down payments on auto loans over the last 3 years.
Mm-hmm.
So they started from a better position as well.
So what does that actually mean? Like, does that just mean that banks are okay with extending your loan because they know you have so much equity in that car?
And yes, I believe in the cases that lenders are actually doing that, but it often also means that consumers can cure their own situation and sell the vehicle. And you've got more dealers buying directly from consumers. You had Gimme the VIN on. You've got all of these venues to potentially capture the equity in the vehicle that's far easier for consumers. So fundamentally, I think that and being employed and having above average wages are causing consumers to sort of cure their situation, either with the lender or by their own activities. We do see problems with where there are problems with loan vintages are used loans made in the second half of 2021 and virtually all of 2022. They have above average defaults. They have below average equity in their vehicles because those people bought at the peak of used vehicle prices and have seen above average depreciation since then. So that reduces the options that those consumers have, either in the marketplace or with the lender.
Does that pose any systemic risk, or is that just like a vintage that's going to get wiped out and the rest is history?
I don't think it causes systemic risk because what we see with the asset-backed securities or the specific lenders is the rest of their portfolio is performing better than normal. So even on an individual lender basis, you're not likely to see defaults even kind of get back to full normal levels. It would take a recession. It would take a scenario of people losing their jobs in the millions to really cause more of a systemic issue.
Got it. And moving forward from here, right, based on trend, what do you see happening with delinquencies and repos for the next, 2 to 3 quarters, or at least 2 quarters? What are you seeing there?
Well, I'm hoping to see delinquencies no longer go up. I'm expecting that because real wages have turned positive this summer, meaning when you look at wage growth relative to inflation rate, most households are now back to a scenario that at the end of the month, they're getting ahead rather than falling behind.
Mm-hmm.
And if so, I would expect with prioritization for auto, people don't want to lose their vehicles. They know how expensive it is, to replace it, especially if their credit gets dinged. I'm expecting delinquencies to improve or at a minimum not get worse. And I'm not expecting defaults to end the year even back to 2019 levels, but I'm expecting them to slowly move in that direction, which means that, yes, we'll continue to see more repossessions each week, each month, because we're simply returning to normal default rates from a very low level of defaults. Plus, by the way, we have record number of loans outstanding. So that alone, even if the default rate was consistent, you would see more defaults happening and more repos happening purely as a function of the population.
All right, so I want to kind of sum this up super simply, right? So first of all, if you're in the market for a car, you said look for EVs because from a deal perspective, those are the best deals in the market, right?
Yes.
Great. And then used car outlook, next 3 to 6 months, what do you see there?
I think many people should continue to see lower prices on used vehicles. So it's going to open up opportunities to buy if you're looking for a specific price point or a specific monthly payment. Where the action seems to be the most this year, the part of the used car market that's been strongest are on certified pre-owned vehicles. And those can be officially from manufacturers, but I would say many dealers also offer their own certified program. And in many cases, that's a super win for a consumer because even though the vehicle's advertised price may be higher than a non-certified unit, when you factor in what you're getting with an extended warranty in many cases and with what is most of the time a much better interest rate, you end up with a monthly payment that more than compensates for the higher price paid. So it's a win-win for the dealer and the consumer alike.
All right, so give us the rest of your takeaways. Like anything else that we missed, right? We spoke EVs, we spoke Teslas, we spoke strikes, new car, used car, lending. What am I missing?
Well, I mean, looking out the horizon, we're constantly trying to figure out what's going to happen next week, next month, and the next 5 years. And I think the worst is behind us. I'm increasingly optimistic that we'll avoid a recession for the economy. I think the consumer remains resilient because of the labor market, and I think we can thread the needle and make it through. If so, the vehicle market is past its worst point in every channel. And our outlook has growth in every channel, meaning every sales channel, whether you're a franchise dealer, an independent dealer looking at the used market versus new, all of it has growth in the years ahead. But I would argue it's a mixed story because when you look at it, what we're going to take is 5 years to get us back to 2019 levels of transactions. So competitively, if you're a dealer in the marketplace, it's actually going to be just as hard, if not harder. We're supply constrained on used vehicle inventory. So a lot of dealers, especially franchise dealers, have enjoyed tremendous growth in the used market. And the playing field is going to be a little bit more level between independent dealers and franchise dealers over the next several years, unlike the environment we've had for the last 5 years that has decidedly favored franchise dealers at the expense of independent dealers.
Why do you think it's going to be a bit more level though?
Because of the age of vehicles that are available to sell in the car park. What we're missing are vehicles that are less than 5 years of age, which is precisely what franchise dealers sell. And what we have millions more of available, you just need to get the consumers to sell them to you or trade them in, are vehicles that are more than 5 years of age. And so for franchises to even maintain their level of used retail sales, they're going to have to sell older vehicles, which is putting them in the domain of competing more directly with independents. And I think some are going to choose to sell fewer used vehicles, and they'll be happy because the new market is coming back for them and they're much more profitable than they have been there, and they're seeing profits in other parts of their business. But it's still going to be a rough road for independents.
So you think just independents are going to suffer the most?
No, I think that inventory leveling out a little bit will help independents do better than they have, because this is their what was it called? Their flywheel.
Yep.
They can operate, and they know best how to perform. And there's no question that if you cater to a credit challenged consumer, that's where there's pent up demand. There's been an absence of people buying over the last 2 years that I think will increasingly come back into the market as we see interest rates come down, and they will come down. I'm not optimistic that we're going to see rates down 3 full percentage points from where we are today, but I would be willing to bet within 2 years we'll be down at least 2 full percentage points. And that can make a meaningful difference.
Do you think so? What do you have to say to the higher for longer camp, right? People think rates are going to be higher or longer. Why do you think rates are going to come down?
Well, I think in terms of Fed policy, you have to buy what they're selling right now and believe that they're going to remain high.
Yeah.
I think most of what I'm seeing from macro economists is that the Fed probably won't start cutting until late next year. And when they do, they're probably going to cut rates by about 2 full percentage points, but it'll probably be gradual, like a quarter of a point every quarter or something like that. So it'll take us 1 to 2 years to see those rates come down. But used rates are a function of the bond market and the risk premium that lenders are charging in terms of their specific yield spread. And actually, yield spreads have outpaced what the Fed has done this year. So we could see used loan rates come down 0.5 percentage point or even more, simply if the delinquency rates start to flatten out and improve. And if the economy turns the corner and there's less uncertainty there, you can start to see
that could improve. Yeah.
Because lenders are going to be they are often more willing to be more aggressive in the auto market because the collateral is easier to retrieve. And if we're proving that vehicle values have no more correction to them, again, that just reinforces their attitude.
It can be a little bit more risk on. Mm-hmm.
Yeah.
I love it. Jonathan Smoke, this was great. Very insightful. I think people are going to love it. So any last thoughts?
Oh, just keep it up, Guy. You've done the industry and consumers alike a service with this. I enjoy listening to every single one of the podcasts. There's always something I learn.
You have to tell us one secret. Do you have a Twitter burner account? Yes or no?
A Twitter burner account?
You're not active. We don't see you active enough. Yeah, I was, sometimes, do a little tweeting and this and that. So
I do actually have 2 different accounts because I have to let my anger out, but that's typically about sports teams and not so much about the vehicle market.
Fair enough. Listen, if you would have said no, I wouldn't have believed you anyway. So it's all good. I love it. All right, dude, this was great. Thanks so much, and we'll talk soon.
All right. Hope you enjoyed that episode. Please give the podcast a rating, consider subscribing to the show, and check the show notes for links to what we talked about. Thanks for tuning in. I'll see you guys next time.